Microsoft has been one of the biggest winners of the AI boom, but how much runway is left in this stock? Well, today we're going to find that out by researching Microsoft stock from scratch. You'll see us analyze the company's moat, the business model, the valuation, and more to find out if the stock can keep powering higher from here. Enjoy. Let's get going. Now, if you're unfamiliar with me, I'm Brian Feroldi. This is my portfolio performance over the last 13 years or so. My portfolio has thankfully outperformed my benchmark, which is the S&P 500.
Yep, and this is mine right here. The green, this is from December 2014, just has year-end numbers. It has outperformed the S&P 500 in the red and the NASDAQ composite in the yellow.
Yeah. So why have we outperformed? This is what we believe as investors. We believe that the foundation of good investing is research. Research enables you to build conviction. Conviction enables you to develop patience, and patience is what enables compounding. The stock that we are going to research today, Microsoft, this is what it would have happened if you invested $10,000 in this company at IPO. 22% compound annual growth rate. 10K turned into $14 million.
And
However,
Brian, we're not alone. Jason owned 5,000 in 95 and sold it a year later. He said it would be worth 5 million today.
that sounds like a multi-million dollar mistake. Yeah, that's hard. But to earn that return, this is what you had to suffer through. Look at the
Woo!
drawdowns
Look
here.
at the 15-year period.
15-year period of underperformance and peak to trough. You bought this stock in 2000. By 2009, you were down 75%. This is why conviction is so important to investing well, and patience is so important to investing well. And we firmly believe that research is the thing that enables good investing. So our goal over the course of this workshop is to let you know how we research a stock from scratch. And we do so with a tool that we built, a system that we built called Stock Simplifier. Here is the 7 steps that we go through as part of the full research process and what we're going to be doing. Stock Simplifier, if you're unfamiliar, contains a full course where we explain everything in detail. It contains the tool that we are going to use, and it contains the AI prompts that we're going to use. So Stoffel, what is step 1?
Well, step 1 is the business growth cycle. But actually, Brian, before we do that, there's a really great question that I just want to hit on because it has to do with what you just said. Gova said Stock Simplifier is fundamental analysis, which I understand is the right way you should invest in a stock. But one of Gova's friends says we don't need to worry about all these data points too much. And technical analysis based on charts will clearly give an idea. I know what my response to that is, but first I'm curious what yours is.
Yeah, so technical analysis can help you to figure out the mood of the market. And if you are quote unquote buying and selling solely based on technical analysis, I would argue you're not actually investing. You are trading based on charts. And how are you going to have conviction in a company or that you're buying just based on the price movements of it? Now, I think that technical analysis can help you with the should I buy this company now? What is the momentum of the stock? What is the emotions of this stock? But to me, that is like the icing on the cake. You still need the foundation to make a good decision. How about you?
Yeah. What I would just say is for me, when I think about this, I think about just you have to zoom out. I think if you're looking at a day-to-day, week-to-week, month-to-month basis, I do believe that technical analysis can help you do things like that. However, the larger point is simply that if you're going over the decades long and you've got to consider taxes, and if you sell out based on technicals, are you going to still be following it to know when to buy back in? Over the long run, I think it helps you narrow down the pool of stocks where you might actually do this in the first place.
There you go. All right. So we would love a poll here. Let's throw up a poll. Which of the 6 phases of the business growth cycle do you think that Microsoft is currently in? Startup all the way through decline. We would love to hear your opinions on that. Now, while people are doing that, I'm going to go over to Stock Simplifier. Here it is, open up. I'm going to click on all course materials. I'm going to get a new spreadsheet tool. Open up. This is our essentially checklist that we use as part of Stock Simplifier. I'm going to make a copy of that. I'm going to get the database of AI prompts. I'm going to load that. I'm going to open up a fresh copy of fiscal.ai, formerly called FinChat, to get that going. And this is going to be the tools that we use to research Microsoft stock from scratch. So in
All
here,
right.
I'm going to
We've
go ahead.
got we got a pretty clear answer here. 72% of our respondents say stage 5 capital return.
Stage 5 capital return is what people say. Okay, so let's go ahead and see if ChatGPT agrees with them. So here's our business phase analysis prompt. I'm going to open up a fresh copy of ChatGPT. I'm going to paste that in there. I'm going to push enter, and we're going to have that going. And if this is working correct, it should say what stock, Microsoft, MSFT, enter. Yeah, very clear. People think phase 5 here. Let's see if AI agrees with them. Microsoft is in quote unquote phase 5 capital return.
There you go.
High conviction in that. Give us the evidence. Operating income was up 17% to 128 billion in fiscal 2025. Revenue grew 15%. Can you see that okay?
Yep.
Okay. Capital return, yes, 9.7 billion returned to shareholders in Q3 through dividends and share buybacks. So since it's in phase 5, the best ratios to use are trailing PE and trailing price to free cash flow. Why this fits, and we should avoid high growth multiples like forward price to sales and forward based earnings. And this means that the company is mature, it's growing strong, and it's returning capital to shareholders, and things to watch for, along with the links to use. So I would agree that this company is in phase 5. Now, how do we come up with these? In Stock Simplifier, we teach you how to match these up with the company's income statement. There's the tool, the spreadsheet tool that you can use to kind of fill these in, and it fills it out. But I'm going to go ahead and say, yes, we're in phase 5, the capital return phase. Now, that's important because the metrics that we use to analyze the business changes depending on which of the phases the company is in, and the same goes for valuation. So that is why that is step 1. Step 2, we need to know, what does this company do? Largely speaking, we want to break this company's business model apart by using its 10K, and we want to know, is this a good business, is this a moderate business, or is this a great business? Here are the 7 questions that we want to ask for our quantitative in need, 3 are qualitative in need, and we are going to run those prompts. So we have a prompt that kind of builds that out. I'm going to make a copy of it. I'm going to go to ChatGPT. I'm going to paste it, and if all goes well, it should pull up the company's most recent annual report, the company's most recent 10Q, and it should give us full analysis on how the business operates. And
Now,
we're
while it does this, Brian, I'm sure most average people walking down the street know what Microsoft is, but I actually highly doubt that they would be able to tell us what all of the different business segments are. And even Tom is bringing up that like OpenAI is like, I think Microsoft now has a 27% investment in them. I mean, even that, it's going to be hard to tease out over time.
Yep, for sure. I would, yeah, to me, it's like if you ask somebody, what does Disney do? What they would tell you
Yeah,
Disney does is they operate theme parks, and that's like 25% of their business.
right.
So companies of this scale are often hard to analyze. All right. So using data from the most recent 10K filed on June 30th, and there is a link to the filing. I love that ChatGPT does that. What does it do? Microsoft is a global technology company that develops, licenses, and supports a wide range of software products, services, and devices. Key offerings: Windows operating system, productivity applications and services like Microsoft 365, cloud infrastructure and platforms, Azure, gaming and entertainment,
Don't
Xbox.
they have Activision Blizzard too?
Yep,
I think they do. Yeah.
that's in their gaming
Yep.
division. Yep, search, advertising devices, and other personal hardware. How does it make money? Revenue streams: productivity and business processes segments was 33 billion in Q4. Intelligent cloud, that to me is Azure, was
Azure. Yep.
30 billion in Q4. More personal computing, that to me is gaming and Xbox,
Hardware.
was
Yeah.
13 billion. Yep, for the full year, total revenue was 281 billion, up 15%. The 10K does not break out each annual percentage within the summary, so I cannot price this on a percentage. But
Sorry.
we can with our friends over at Fiscal. So if I pull up Fiscal and I click on financials, This is why using this in tandem is helpful. If we click on segments and KPIs, right? So we have the three main, right? So they just like, I know they reorganized
Yeah. Yep.
their main ones, right? So productivity, and if we do intelligence and cloud,
I
and
think it
if
was
we
within the
do,
last year, year and a half.
yeah, it was fairly recently. And then we push this button right here to kind of stack them right on top of each other. That gives us a bar chart. So yellow is more personal computing. This business is growing 10% per year. See that CAGR that says 10%?
Mm-hmm.
Blue is the cloud business. This is growing 21% per year, 106 billion over the last trailing 12 months. And then green is productivity in businesses. So this is Windows and kind of the classic business. This
Yep.
is growing 13% per
It's
year.
yeah, it's high margin and it's crazy because it's like what's been around forever. But
Yeah,
they've
so
got Copilot now. They've got some other things.
yeah. So gaming is the slowest grower here at 10%, but and double-digit growth for these very mature businesses is super, super impressive. And you can break them down by individual. Look, they even have LinkedIn revenue, gaming
Yep.
revenue, device revenue, US versus
Got Surface
international.
tablets.
Tons of key metrics that we can look at
They
with
really
this.
do.
But we understand the gist.
Yep.
Who are the customers? Microsoft serves enterprises and large organizations buying cloud infrastructure, small and medium sized businesses, individual consumers, and governments and educational
Basically
institutions.
everyone.
Yep. Where does it operate? Geographically, revenue is 51% in the US, 49% outside the US. I think that was pretty much spot on what yeah, so revenue inside the US 144, outside the US 137.
That looks about right.
Yep. So it got the numbers correct on that. Great.
Hey, way to go, ChatGPT.
How often do customers buy? Microsoft mixes recurring with one time purchases. Many cloud and subscription services are recurring, with customers doing ongoing contracts. Devices are one time purchases. And the large portion of revenue from cloud suggests a strong recurring component. So that's what the business does. Now, the qualitative questions. Do we think Microsoft can raise prices? Yes, says ChatGPT. There is evidence the company has pricing power. Cloud revenue grew 20% and commercial grew 18%. That's not pricing power to me, that's just revenue growth. For search and news advertising, excluding traffic acquisition costs, revenue grew 21%. 10K noted that gross margin percentage decreased in some segments due to scaling AI infrastructure,
That makes
which
total
may
sense.
limit pricing leeway in the near term. Yeah, we know the company is investing tens of billions of dollars into AI infrastructure, which is going to pull down its gross margin. So this is why knowing normally gross margin going down very bad.
Yep.
This is
Yep.
a good explanation for why that's happening.
Totally agree.
What happens in a recession? While specific recession performance isn't deeply detailed, Microsoft has a broad mix, giving it some resilience. Personal computing and gaming may be more cyclical, makes
Makes total
sense,
sense.
and risks around economic cycles and demand in certain segments. And there are the direct sources. So let's actually pull up. I would love to see how far back we can go on an income statement basis. So if I pull up revenues and we kind of just look, let me delete those. And if we just look at revenue, and I'm going to,
There's a little bit of a pullback interesting in
yep,
2016.
2015. So this is when they made the major cloud shift, right? This was
Mm-hmm.
Satya Nadella coming in.
Mm-hmm.
So that makes sense. And growth has just been straight up since then. Even during the pullback in 2022, we saw a lot of customers go out of business in 2021, right in 2022. So, and the company just grew right through that. So, my
Yep.
guess is the company's revenue is going to fluctuate maybe a little bit, or maybe the growth might slow. But I have a feeling that this company will continue growing, even in that. So, what do people think? What do you think of Microsoft, the business? Is this an attractive business? Red, no, kind of, or yes would be green.
And while we do that, Mr. Foley, we've gotten a number of questions asking, will people get be able to watch this? Is it recorded?
Yep, it's going to be recorded absolutely, and everyone that registered for the webinar I'll send you an email later today once the replay is available.
Yep.
Yep,
And
for
I'll
sure.
also say that if you are joining us on YouTube, this will be posted on our YouTube channel as well.
Yep, there you go.
All right. So I'm going to stop because we've got a whole bunch of people who've responded, and 87% give it green. Yes, it's attractive. The rest are all yellow. There was no reds.
I'm going to totally agree with that and say, yes, this is a good business. Great. Okay. Quick reminder: we are using Stock Simplifier to do all of this research. Stock Simplifier is normally $199. If you use the link that Stoffel is going to share in the chat or on the YouTube comments, you can get it for $99. Next question we look at is the company's moat. We want to know, does this company have a no moat, or is the moat weakening? A stable moat, or the moat's narrow? Or does this company have a wide moat that's expanding? There are 5 categories of moats. There are 3 current stasis of moats. So is it narrow, wide, or none? And most importantly, what is the direction of the company's moat? Is it shrinking? Is it stable? Or is it widening? So before we let ChatGPT do the analysis, would love to ask the audience here, what do you think is Microsoft's biggest source of moat? Its primary, most important moat source of the 5 that we had.
And this is interesting because obviously there's a lot going there, as we've already covered. There's a lot of moving pieces here. So I don't think that there's just one, but there's a lot. There's a lot of different moving pieces.
There's one quote unquote primary one.
Yes, I will agree with that.
Yeah,
To
I
me,
don't think you get it wrong about which is the primary one, but this is a company with multiple moats. Which one is the strongest and most durable?
yep. All right. So I'm going to end the poll because we have 2 that basically came out on top. First is switching costs. 54% say switching costs. I would agree with that. And actually, to that point, Tom just very earlier on says, I've attempted to get away from Microsoft and they always keep pulling me back. That's switching costs. And 37% say network effect.
There you go. All right, so let's run our moat prompt in ChatGPT and see what ChatGPT says. Uh, Microsoft MSFT. All righty here. Do you have a strong feeling about which one you would go? Oh, you said switching costs, didn't you?
Yeah, I would say switching costs.
Yeah, I would say the same thing. So moat is wide. The moat direction looks stable. Primary source is switching costs and network effects. So the viewers here exactly nailed it, or at least ChatGPT agrees with them. Microsoft's ecosystem is productivity, cloud, and enterprise services, creates high customer lock-in and a growing flywheel, giving it a durable advantage evidenced by consistent double-digit growth in Azure and large recurring business. So switching costs are wide and the direction is stable. Microsoft benefits from deeply embedded on its platforms, Office 365, Windows, and Azure, and broad enterprise contracts. Once migrating away is disruptive and time-consuming. And that's some quotes for you. Intangible assets. So narrow and stable. The Microsoft brand name and intellectual property of Azure, Office, and Windows are strong, but they're not switching cost. They're not as strong as a switching cost moat.
I
I would
agree.
say I agree with that.
Yep.
Network effects are narrow, and they are widening. Microsoft Cloud and productivity platforms gain value as more organizations use them. Huh. Do you
Well, I,
agree
I
with
mean, I
that?
guess this is that classic. The more you use it, the better the AI is. The better the AI is, the more people would want to use it.
Well, it could be that the more people that Windows used to have a network effect where
Well,
which
yeah,
platform did you want to develop on? The one like
that
you
everybody
developed
else
for
is
one
using.
platform,
Yeah.
and there was a lock-in or sharing files like Excel files or Google.
I think Google has disrupted that
I think so too.
quite a bit more than I would have thought was possible 10 years ago.
I would say so too. So I would say maybe there might be some network effects that we are not aware of with Azure and Copilot, but less dominant than a pure play company. So narrow but improving. I'll say narrow and stable personally. But there you go. Low cost production not present. Counter positioning not present. So and then there's some risks about AI infrastructure, the competitive landscape of Google, Alphabet, and Meta. And Morningstar gives it a wide rating, but an uncertainty rating. So I'm going to go ahead and say This is a
Yeah.
wide moat business. The moat is probably stable at worst, expanding at best, but very attractive nonetheless. Next, growth. Does this company have bad, good, or great growth potential? There are two sources of growth that a company can have: get new customers or get existing customers to spend more. If you want new customers, you got to acquire them through new distribution, new markets, acquisitions, or spending on sales and marketing. If you want existing customers to spend more, you raise prices, you introduce new products, or you improve retention. Now, the shortcut that we show you to figure out does the company have growth potential is right on fiscal. We go down to long-term EPS growth, and Wall Street believes this company's long-term earnings growth rate is about 12% per year, and revenue is expected to grow 15% annualized over the next 2 years. Similar number for earnings per share. But that's the headline.
Yep.
Why should we believe that the company can actually do that? What is the thesis that gives us conviction that the company can actually achieve those results?
Yep. So I'm kind of curious because I've always thought that with companies like Microsoft, because to be clear, when we talk about growth potential, we're talking about top line.
Mm-hmm.
There are ways that you can cut operating expenses so that you get bottom line income growth. That's like the third lever beyond new customers and existing customers.
Yep, for sure. Microsoft. So balance combining new customers and existing customers. So the top drivers, nice and color coded. Okay. So marketing and sales investment. This says moderate because of its scaling investments in capital infrastructure in capital expenditures. Distribution channel is moderate. The growth in AI workloads and new services expands distribution beyond legacy channels. Geographic is strong. The company's cloud business is growing. Um,
I would say it's even more market expansion. I mean,
yeah,
people are just jumping on to the cloud still. It's hard for us, right? When we're in this world, we think everyone's on the cloud already. But
yep,
then you go out to businesses in your community and you're like, oh, you're not on the cloud yet.
yep. Acquisitions, moderate. I would say that, I mean, it took Microsoft multiple years to get even Activision Blizzard closed. So I don't think that that's going to be a major source of growth for the company. Major source of growth, a source of growth for sure. Pricing power, moderate. The company can increase pricing and volume. New products is very strong.
Yep.
Azure surpassed new revenue growth and workloads, and that's a high confidence. And then customer retention is moderate, making the products even stickier. So new products and services such as AI and geographic market expansion,
Totally
pricing
agree with that.
pricing power, higher retention, acquisitions and market and sales and marketing investments. Untapped is new distribution channels. So yellow, yellow, green, yellow, yellow, green. All right, taking all of that in, what do you guys think? Given Microsoft's size and scale, does this company have good growth potential, great growth potential, or poor growth potential?
You know, this is a funny one because if this was just like of all the stocks I'm invested in, what would I give this? I would give it a yellow. But like you said, if you consider the fact that I think as of today, Microsoft is a $4 trillion company. Well, that's a little bit different. I would personally, I would give it green.
You are correct. It is a $4 trillion company. Wild.
Yeah.
Absolutely wild. All right, what do people say?
Yep. Basically, 2/3 say yes, green, great growth potential. The other 1/3 say good, yellow growth potential.
Awesome. All right. A friendly reminder: if you want to grab everything that we're using, all the tools, Stock Simplifier, there is a link in the chat and on the YouTube comments. Okay. Next question: what are the key metrics for to watch when a company is in this stage? The key metrics that we look at to judge a business change depending on the phase that the business is in. For a phase 5 company like Microsoft, we believe the key numbers to look at are revenue growth on a 3-year basis, free cash flow conversion, EBIT to interest expense, return on invested capital, and the capital return programs. Now, we do have a prompt that analyzes this. This is the prompt that we have had the hardest time getting to work properly because we're requiring ChatGPT to do math. And it's not the best at math. So we will
And I
try
would
this
say
and
not just math, but also do time. We ask it to
yes.
correlate specific times, which I actually find sometimes I ask ChatGPT what day it is and it gets it wrong. So
All right, so we'll see what it says. Oftentimes it gets these colors wrong, but that's why we always double check the numbers with a trusted source like Fiscal. Okay, so revenue growth on a 3-year basis, it's giving a yellow rating, even though it's 12.4%, even though the target is green target is over 10%.
I am on fiscal. I get 12.4 as well.
12.4 right there. So this number is correct, but this color is wrong. This should be green, and the trend here is good. Okay, next, free cash flow conversion, 71 billion in free cash flow divided by 100 billion. That's a 70% free cash flow conversion. That is a yellow. That is correct, assuming
Mhm.
that these numbers are accurate. EBIT to interest expense, earnings before interest and taxes over its interest expense. Interest coverage is 55
And
times. That's a green.
less than 1% of their less than 2% of their operating income goes towards interest payments.
Yep. So this is why we chose this metric, by the way, versus just balance sheet strength, because it's a good proxy for can the company afford to make its debt payments? Yes. No problems. Next, return on invested capital. This is saying 29.6%. We want
But
anything
it
over
gives you
20.
return on equity.
You're right. That should say return on invested capital. Well, return on invested capital is right here on a 5-year average is 26.8% over the last 5 years. So
Green.
this one is wrong. This one's wrong, but and this should be green. And then capital returns, it had yes, it's done capital returns for 5 plus years. If we click on dividends, for example, I think they started paying a dividend, yeah, back in 2003. That's a pretty good track record of
Pretty good.
dividends. So strengths is interest coverage and long-term capital returns to shareholders. Concerns are free cash flow to net income. That is definitely something to keep an eye on, and the delta there is because of AI spending. And revenue growth, I would say that this is actually a strength given the
Yeah.
company's size. And then critical points to watch is that conversion ratio there. So if we were doing this, so I'm gonna agree. So revenue growth over 10%. This is a yellow. This is a green. This is a green, and this is
And
a green.
and think about that. The only reason that there's any yellow there is because you have to spend so much on Nvidia chips.
Yeah,
Basically, that's it.
that's right. That's right. Okay. Any questions we have so far, Brian, that you see
Yeah.
in the chat?
So here, anonymous attendee asks, how do you assess the risk when countries other than the US encourage their governments or even their companies to stop using software from the US? I mean, for me, that's just a hard one to do, but I don't necessarily see that happening writ large outside of the United States for Microsoft. There are others like Nvidia where you might have to worry about that.
So we're going to cover exactly that thing in the risk section. That I categorize as a outside forces risk, right?
Mm-hmm.
Microsoft has no control over the relationship that other countries have with the United States. And that is a force that is outside of Microsoft control that could impact the company. How would it impact the company if that was to happen? Revenue growth would likely slow. So that's where the execution risk would flow through. So that's how I would think about it.
One more question that we got. Jason says, when we're done with this, um, was there any chance of doing technical analysis on this? And what I would say, Jason, to that is a separate program that we have. It's not focused just on technical analysis, but it layers in technical analysis. So if you want to find out more about that, we are actually going to be having a webinar that discusses that program, Stock Investing Mentor, coming up in the next couple of weeks, and you'll get an email about that.
Yep. So remember, this is stock
Simple.
simplifier. Technical analysis is stock complicator. So it has its place certainly, but this is designed around the simplest research that we can do. Okay, great questions. Keep them coming. Next is risk. We believe all risks boil down to one risk: execution risk. what is the chances that the company, what are the things that can prevent the company from achieving the results that we want it to or that we need it to in order for this investment to pay off for us? There are four core risks that go into execution risk: concentration risk, disruption risk, outside forces risk, which is where that risk we were just talking about would land, and then competition risk. So let's have AI do some risk analysis on Microsoft to see what it thinks of those key risks.
I'm curious about this.
Me too. Okay. Overall risk level is medium. The primary risks are competition risk and outside forces risk.
Oh, there you go.
And mitigators are the diversified business, strong balance sheet, and recurring revenue streams. So
Agreed.
concentration risk, no problem here. No revenue, no single customer is more than 20% of revenue. Disruption risk. This is a yellow risk. Recognizes risk of being disrupted by new technologies and involving market conditions. Cloud/AI, which moderates the downside risk. It is investing in disrupting itself.
I'll just throw in there that what happens with OpenAI could be an example of that too. Like so far, that seems like a really great investment. But if something were to happen with OpenAI, it can go in both directions.
Sure can. Outside forces risk. This is a yellow risk that is worth company. Significant exposure to regulation, cybersecurity, geopolitical risk, and supply chain data center build-out commitments. Large capital expenditure for expansion. Will those investments pay off? We don't know yet. And the macro risks are intensifying. Global regulation on tech, rising costs, so the trend is upward. Final one is competition risk. It says red. The 10K states we face intense competition across all of our markets, which may adversely affect our results. With the cloud being mentioned, competitive intensity is high and persistent, showing no clear signs of improvement. So green, yellow,
I
yellow,
I would
red.
not say red there. Like I don't. If they didn't have a moat, I would agree with that. But
Yeah.
I think we've established that they do.
Yep. Well, this is why we ask ChatGPT, and then we use our brain to say, like,
Yep.
okay, that's what it's highlighting. Do we think the company's moat can protect it from those risks? So let's do a poll here. What do you guys think? What is the execution risk here for Microsoft? Is it high risk? Is it medium risk? Or is it a low risk on the execution front?
I might have like a somewhat surprising for myself answer to this.
Well, what is your answer?
I actually think mine would be green. Like
Okay.
I know that that seems ridiculous, but I don't see Microsoft in the crosshairs of regulators nearly as much as a lot of the other players. Like they don't have that monopoly threat. But the other part is just that like the things that they do have are just so ingrained. And
Yep.
even though Google came up with Google Sheets and Google Docs, like it still didn't really hurt the business that much.
People are still paying for Windows and all those kind of tools. So what are the results here? What do people say?
Yep. So 70% say yellow, medium risk, and basically the rest, the other 30% say green, low risk.
Okay, I'm going to agree with you. I'm actually going to say this is a low risk on the execution front. There are certainly low risk doesn't mean no risk. It means low risk. So there is regulatory risk, there is competitive risk, but I also agree that it's probably pretty low in the absolute scheme of things here. Feel free to disagree with that if you believe differently, but I would say low risk myself and
Of
vote for that.
of course, there is another type of risk we've got to talk about, which we're
Sure.
covering next.
So 1 through 6 here was understanding the business and the business model and the growth potential and the key metrics. Thing 7 here is valuation. The best business in the world is a poor investment if you dramatically overpay for it. So this is a company that is in phase 5, the capital return phase. So the primary way that we value this company is on the PE ratio and the price to free cash flow ratio. Now, AI is not good at helping at this
Nope.
just yet, or at least that we've discovered. But this is where fiscal comes in. So if we go to the financials, and then we click, I'm going to turn this one off, and then we click down to ratios. This is where the valuation ratios do hide. We're in the trailing valuation ratios right here, and I'm going to click on PE ratio and scrolling up here. Here is Microsoft's PE ratio over the last 10 years. Looks like something happened
I'm trying to
here.
remember what that would be.
So I'm going to just erase that from the timeline.
Start in 19. Yeah, there you go.
Yeah, to give ourselves a couple of years here
It's
to
like
look at.
6 years.
Graphing line, I do median, high, and low. And we see that this company has traded for a median price of 34 times earnings over the last 6 years. It got down to 23 times earnings in the bear market of 2022. Currently 39/40 times earnings, which ties its peak achieved in
COVID.
2020.
Yep.
Okay, so that's one metric. How about price to free cash flow? I have a feeling this is going to look even worse.
Yep.
All right, so there's price to free cash
And
flow.
and we got to remember why. It's because of the AI build out. All those capital expenditures pull the number down because that did not because yeah,
Well, the longer back I go,
the worse it gets.
the worse it gets. So when Satya took over, this company was trading at 16 times free cash flow. It's averaged 32, currently 56. And if we just stick to since post COVID, if you want to do the last 3 years, you see
I mean, no
41
matter
times
how you
free
cut it,
cash
it's up
flow.
there.
Yeah. So, all right, what do people think of this valuation of Microsoft today? Is this undervalued? Is this fairly valued? Or is this an overvalued company?
And unsurprisingly, we're getting the same kind of breakdown we usually get, where 2/3 of people say one thing and another third say another. Although it's evening out a little bit. We've got most people have responded, so I'm gonna share the poll. What we see here is that 56% said red, it's
Mm-hmm.
overvalued. 42% said yellow, it's fairly valued.
Yep. I'm going to go with overvalued on both metrics. Okay. Taking everything into account, what do you guys think of this stock today? Is this stock a buy? Does this interest you? Red is no, not interested at all. Yellow is maybe, perhaps I'm going to put it on my watch list. Green is yes, I am interested in buying this stock today. Highly interested in this company, taking everything into account. I think we all agree this is a sensational,
Mm-hmm.
sensational business. But the great business at the wrong price does not mean a good investment. All right, what would you? I would love to know your opinion here, Stoffel, before we share.
I would be a yellow if I owned. I mean, look, the way that I account for this risk is that I just think about position sizing. And because Microsoft is so big, I don't own it because it's not a screaming buy. If it was one that I thought could 5x from here, I would still hold it. It would be yellow.
Yep,
What we got was pretty much the same thing. 58% of the people said yellow, and then 23% said red, 19% said green. So there was a little bit of everything in there.
perfect. Yep, I would largely agree with you. I think that this is a sensational business, but I do not want to pay any price for a business of this size. As a general, broad statement, the further along the business growth cycle a company is, the more we emphasize valuation, or the more I emphasize valuation. Microsoft is very clearly deep into the phase 5 of the business growth cycle. It's in the capital return phase. So I think emphasizing valuation makes sense to me. This is not a stage 3 company with like infinite growth leverage ahead of it. It was in the 1990s and in the 1980s, but I would buy this company at the right price.
Let me ask you this, Brian. C brings up a good point. Why not look at the price to operating cash flow just to
Sure.
see what that is? And for those that might wonder why, operating cash flow takes out all of those capital expenditures on NVIDIA chips and just compares it to the cash that the business generates without those capital expenditures. So, I mean, we look at
Let's
that and
do it.
Brian, yeah, what do we see? And I bet you could pull that back even more too over the timeline.
Yeah. So this is price to operating cash flow, as whoever said that is. This does not account for capital expenditures. So this neutralizes the heavy expending that they've done on capital expenditures on those AI data centers. So it kind of neutralizes this. This is a good test to do if a company is going through a capex build out, like
Yeah.
Amazon is, like Facebook is, like Google is. On this metric, 29 times X operating cash flow, and it got down to
20 basic
18.
or 19.
Yeah. So this figure has averaged 24 over the last decade, currently 29. So good insight by whoever said that.
Yep. Yep. I agree. Let me ask you this. Gova says, if we use Stock Simplifier, how do we know when to trade, like buy or sell? Is there a simpler way to do this? One thing I'll say is that's kind of what that end thing was, like buy, sell, or hold, but it's Stock Simplifier. So this is priming your brain for the next step.
Totally. The stock simplifier is this a company you want to own? Is this a company you want to put in your watch list, or is this a company you don't want to know at all? Well, in our research and talking to lots of investors, so many people own stocks and they don't know how. They've never done the research. They don't know how to do the research. They don't know how to open a 10K. They don't even know what to look for to assess the business. That's what we created Stock Simplifier for, was to give you a checklist to go through to really analyze just the basics, get you 80% of the information that you need so you can make an intelligent decision or not. It's not going to tell you, yes, this is a buy, no, this is not. That is on you to figure
Mhm.
out. It's designed to help you unearth the insights so that you can make an informed decision.
Yep. Olivier has an interesting question. Curious to hear what you'll say to this. Well, why is the stock price fundamentally going up, although the valuation tells you to walk away from it?
Because in the short term, the valuation doesn't matter. And in the short term, stock prices trade on momentum, they trade on news, they trade on a sentiment. If you're buying Microsoft's stock today using something like technical analysis, you're just betting that you can sell it to somebody tomorrow for a higher price. Markets, in my experience, tend to look about six months out, or
Mhm.
something along those lines. But valuations don't matter over the short term, but they do matter over the long term.
Cass is wondering what your 2047 and my 2046 stand for.
So when I turn 65, it's a
That's right.
reminder to think long term, like our
That's
company,
right.
long term mindset.
Fatit is asking, wouldn't it be better to look at the PEG ratio? And we kind of touched on this yesterday. What's your response to that?
Price PEG is PEG, price to earnings to growth. It's a way of comparing the company's price to earnings ratio to its growth rate. This was popularized by Peter Lynch, and he for years said PEG of 2 or higher is expensive, PEG of 1 or lower is inexpensive. So we can do that analysis if you want to. I don't think that the peg is as nearly as useful as it used to be, but let's go ahead and do that analysis. So the trailing PE ratio is 40. Let's call it 40, and the growth rate is 12%. So 40 divided by 12 is
3 point something.
3.5. 3.5. So if you just use the peg ratio, you would want to pay no more than 24 times earnings for this business.
Yep. So I will also say, so Tom brings up a really great point. And actually, if you subscribe to our newsletter, I talked about this recently because he said, if Brian, if we did this valuation back when it was a $3 trillion company,
Mm-hmm.
what would we have said? There's a chance we would have said it was overvalued then too. I would say it wouldn't be as overwhelmingly overvalued, but I get that sentiment. One of the tough things is when momentum is going up, that's why I always say trim. You don't need to sell out entirely, but you can trim and you can trim and you can trim because you can still capture some of that.
So when this was a $3 trillion company, would have been basically January.
Mm-hmm.
So, well, we can look at the
We
we
can look
can
at the PE
yeah, let's
ratio.
look at the PE ratio
What
back in January. Let's close this out. Ratios, and then we'll go to price to earnings ratio. And back in January, this PE ratio was 33. Wow, it bottomed out at 28,
Mm-hmm.
28, and has peaked at kind of 30, 39. So if we just do this year, we just do like the last kind of year, I'd argue, maybe at 30 times earnings, this business starts to become
A little
attractive,
more
or
attractive.
a little bit more attractive. And while we're here, let's just look at the forward price to earnings ratio, because that does account for a growth. So this is the PE ratio divided by next year's earnings. So this got down to, call it 25 times forward earnings if you're using just the forward price to earnings ratio.
Mm-hmm.
Here it's 22, got down to 22 times forward earnings. So there have been periods over the last, call it 5 years, where Microsoft was much more attractively priced than it is today. So yeah, at a $3 trillion valuation, it's more attractive to me, but it wasn't even a screaming buy back. It wasn't a screaming buy back then.
And the
But
tough part
that's
about this
my
is
assessment.
the best quality companies will almost never be screaming
Right.
buys because people know that they're some of the best quality companies.
Or
So
it's
Brian,
extremely rare.
yeah, Brian said, if you already owned, how would you position it? And I like the answer that we got from Joseph. He said, trim if you're a trader, but not if you're long term. I mean, in general, I don't think you can go wrong. I think the real answer to that has to do with what your goals are as an investor and what is the position size we're talking about here,
Yep.
right? Because if it's 5%, that's very different than if it's a 15% position.
Yeah. By the way, if you own the QQQs, if you own the Qs at all, you already have a 8% position in Microsoft. If you own the S&P 500, you already have a
I think it's 6.
7%
Yeah.
position in Microsoft. So if you're an index investor, in addition to any individual stocks that you're holding, you do have direct exposure to Microsoft already, even if you can't visually see it.
Yeah, totally agree.
Yeah.
Robert says, depending on execution of AI implementation and integration, could this company's phase adjust back to phase 4 with a high growth rate? Yeah, I think it could become a hybrid, 4 or 5, just because I don't think it's going to stop returning capital to shareholders either.
Yeah. So the six phases that we have are a fantastic mental model, and we use them there to simplify things. We think that so many people skip over. They don't even know that the mental model exists, and it's extremely helpful for figuring out what you should focus on depending on where the company is in the stage. Once it gets to stage 5, a company's growth rate can increase or decrease depending on what's happening in the market, but there's no reason that you can't look at more metrics than the ones we've done in Stock Simplifier, or use different valuation metrics if you want to value it kind of a fast growing stage 4 company, or even a stage 3 company. But again, the goal of Stock Simplifier was to simplify things as much as possible. But there's no reason you can't do additional analysis on top of that if you feel comfortable.
Yeah. And I'll say for me, like when I'm valuing a company that could be 4 or 5, I'll look at the forward and the trailing PE, price
Totally.
to free cash flow, and sometimes even price to operating cash flow.
Totally. Yeah, absolutely. Olivia says, Microsoft versus Apple, which company ought to have the strongest momentum? If you force me to pick between those two, I'm taking Microsoft.
Yeah. I guess I probably
I
would
have a
too,
heck
but
of a lot more confidence in Microsoft's growth potential and achieving its growth goals than I do Apple.
I don't own
Es-
either one. So you
Especially
should
since both valuations are
high.
similar.
Yeah.
Similar. They're similar. But if you force me to choose between Microsoft and Apple, I would pick Microsoft.
I think I probably would too.
I don't own either directly
And that might be
myself,
the
with
most
the
important thing.
with
Yeah.
the with the exception of saying my children own Microsoft.
There you go.
Yeah, there you go. Cool. Well, guys,
All right.
thanks so much for joining us for this session. We really hope that it was helpful. As a reminder, with Stock Simplifier, if anything we said confused you, we have a full course that breaks down every single component of this in more detail. You get access to the prompts that we have. You get access to the checklist that we have. There's also a 30-day money-back guarantee on it, and it's $99. We think it's an incredible value if you're the type of person that wants to research stocks yourself using the tools that we give you. So
And we got the exciting ones coming up.
Yeah, so next week is going to be the end of this Mag 7 series. We're going to be researching Nvidia stock from scratch on Tuesday, Tesla stock from scratch on Wednesday. So a week from today. I think all those companies have reported earnings or not have reported earnings. So
Nvidia has a weird calendar, but Tesla has.
there you go. There you go. So Tesla, we will have the most up to date on, and I have a feeling that's going to be the hardest one to
Yeah,
research,
oh, it's definitely going to be the hardest one. There's no
given the
doubt.
complexity of that business model. But a lot to look forward to. We hope you guys are enjoying this series, and thank you so much for spending some time with us. We really appreciate you doing that. We will see you guys next Tuesday. Happy Mag 7 earnings week to everybody. Brian's out.